I'm watching something that terrifies me, something that feels exactly like 1999 all over again. Except this time, the bubble is even bigger. The valuations are even more absurd. And the crash, when it comes, is going to be even more devastating. I'm talking about artificial intelligence. The AI bubble. And if you think I'm exaggerating, if you think AI is different this time, let me tell you why you're wrong. And let me explain exactly how this ends. Because I've seen this movie before. I lived through the dot-com bubble. I watched companies with no revenue, no profits, no viable business model get valued at billions of dollars. I watched rational people convince themselves that traditional metrics didn't matter, that eyeballs and page views were more important than earnings, that the internet changed everything and the old rules didn't apply. And then I watched it all collapse. I watched the NASDAQ fall 80% from peak to trough. I watched trillions of dollars in wealth evaporate. I watched hundreds of companies go bankrupt. I watched investors lose everything. And right now, I'm seeing the exact same pattern with AI. The exact same irrational exuberance. The exact same suspension of disbelief. The exact same willingness to ignore fundamentals and bet on a story. Except the scale is bigger. The valuations are higher. And the crash is going to be worse. I'm Michael Burry. I predicted and profited from the subprime mortgage crisis. I saw that housing prices couldn't keep rising forever. I saw that borrowers couldn't afford their mortgages. I saw that the securities backed by those mortgages were worthless despite being rated AAA. And I bet billions against them while everyone told me I was crazy. I spent months in 2005 and 2006 reading mortgage documents, analyzing loan files, understanding what was actually in these mortgage-backed securities. And what I found was fraud. Systematic, widespread fraud, borrowers with no income documentation claiming to make hundreds of thousands of dollars, adjustable rate mortgages with teaser rates that would reset to levels borrowers couldn't possibly pay, appraisals that inflated property values, rating agencies that rubber-stamped AAA ratings on garbage. The entire system was built on a lie, and I knew it would collapse, so I bought credit default swaps. I paid premiums every quarter to insure against these securities defaulting, and everyone said I was wrong. Banks sent representatives to my office to explain why I didn't understand modern risk management. My investors wanted to pull their money out. People thought I'd lost my mind. Then 2007 came. The mortgages started defaulting. 2008 came. Bear Stearns failed. Lehman Brothers failed. The entire financial system nearly collapsed, and my fund made over 700% returns while trillions in wealth was destroyed. I was right because I did the work. I ignored the hype. I looked at the fundamentals. I understood that math eventually matters, that cash flows eventually matter, that you can't sustain valuations based purely on hope and narrative. And right now, with AI, everyone has forgotten those lessons. Let me tell you what's happening in the AI sector and why it's going to end badly. Companies are being valued at hundreds of billions of dollars based purely on the promise of AI, not on current revenues, not on current profits, on the promise that AI will eventually generate massive revenues and profits. Maybe, someday, in the future. Nvidia is valued at over $2 trillion. That's trillion with a T. Their market cap is larger than the entire GDP of most countries. They make chips, good chips. Chips that are essential for AI training and inference. But are they worth $2 trillion? Let's look at the numbers. Nvidia generated about $60 billion in revenue last year, about $30 billion in net income. So they're trading at about 67 times earnings. For a chip company, a cyclical semiconductor company in an industry known for boom and bust cycles. Is that justified? The bulls say yes. They say Nvidia is going to keep growing revenue at 50 or 100% per year. They say every company in the world needs AI chips. They say Nvidia has a monopoly and can charge whatever they want. They say traditional valuation metrics don't apply because AI changes everything. I've heard all of this before. In 1999, Cisco was the Nvidia of that era. Cisco made routers and switches, the infrastructure of the internet. Every company building out internet infrastructure needed Cisco equipment. Cisco had a dominant market position. Cisco was growing revenue at 50% per year, and Cisco's stock went to the moon. At the peak in March of 2000, Cisco's market cap hit $550 billion. It was briefly the most valuable company in the world. The stock was trading at over 100 times earnings, and people said traditional valuation metrics didn't apply. That Cisco was the infrastructure play for the internet revolution, that every company in the world would need Cisco equipment. That growth would continue indefinitely. Then the bubble burst. The dot-com crash happened. Companies stopped spending on internet infrastructure because they went bankrupt. Cisco's revenue and earnings fell. The stock collapsed. It fell from $80 to $8. It lost 90% of its value, and it took 15 years for the stock to get back to its 2000 peak. People who bought at the top lost everything or waited over a decade just to break even. Nvidia is Cisco. The same story, the same dynamic. A great company with real products and real technology, but valued at levels that assume perfect execution and unlimited growth forever. That's not realistic. But Nvidia isn't the only problem. Look at the broader AI ecosystem. Microsoft is valued at over $3 trillion, partly because of AI, their Copilot products, their investment in OpenAI, the promise that AI will boost productivity and revenue across all their businesses. Google, $2 trillion, AI search, AI advertising, AI cloud services. The promise that AI will defend their search monopoly and create new revenue streams. Meta, over $1 trillion. AI for content recommendation. AI for advertising targeting. AI for virtual reality. Amazon, $2 trillion. AI for e-commerce. AI for AWS cloud services. AI for logistics. These companies are collectively valued at over $8 trillion. That's more than the GDP of Japan and Germany combined. And a significant portion of that valuation is based on AI. On the belief that AI will generate hundreds of billions in new revenue and profits. Maybe it will. Maybe these companies will successfully monetize AI and justify their valuations. But what if they don't? What if AI doesn't generate the revenue growth everyone expects? What if the costs of developing and running AI systems remain high while the revenue benefits remain modest? What if competition drives down prices and margins? What if regulatory concerns limit how AI can be used? What if the technology hits fundamental limitations? Then these valuations are absurd. These stocks are overvalued by trillions of dollars collectively. And when reality sets in, when growth disappoints, when the AI narrative cracks, the crash will be spectacular. Let me tell you about the AI startups, because this is where the bubble is most obvious, where the insanity is most concentrated. OpenAI, the company behind ChatGPT, was reportedly valued at $86 billion in a recent funding round. $86 billion. For a company that's losing money. That reportedly burns through $5 billion per year in computing costs alone. That gives away its product for free to most users. That charges $20 per month for the premium tier. How many premium subscribers do they need to justify an $86 billion valuation? Millions. Tens of millions. And even if they get there, even if they have 50 million subscribers paying $20 per month, that's only $12 billion in annual revenue. At an $86 billion valuation, that's over 7 times revenue. For a company with massive costs and no proven path to profitability. That's insane. Anthropic, another AI startup, raised at a valuation of $18 billion. Inflection AI raised at $4 billion. Character AI was valued at multiple billions. These are companies with minimal revenue, with massive costs, with unproven business models. But they're valued in the billions because investors believe AI is the future, that whoever wins the AI race will print money. That traditional metrics don't matter because the potential is unlimited. This is exactly what happened in the dot-com bubble. Pets.com raised hundreds of millions. They sold pet supplies online. They lost money on every transaction. But investors didn't care because internet commerce was the future. Webvan raised over $800 million. They delivered groceries. They lost money on every delivery. But investors believed they'd achieve scale and become profitable eventually. They went bankrupt. eToys raised hundreds of millions. They sold toys online. They competed with Amazon and traditional retailers. They lost money consistently. They went bankrupt. Hundreds of companies with .com in their name raised money and went public at absurd valuations. Most went to zero. Investors lost everything. And the same thing is going to happen with AI startups. Most will fail, most will burn through their funding and shut down. Most will never find a viable business model. The investors who funded them at billion-dollar valuations will lose everything. Let me talk about the business model problem with AI, because this is critical and most people don't understand it. AI models are expensive to train. Training GPT-4 reportedly cost over $100 million in computing power. Training larger, more capable models will cost even more. Maybe hundreds of millions, maybe billions. Then there's inference cost. Every time someone uses ChatGPT or Claude or Gemini, it costs money. Computing resources. Every query burns through tokens, uses processing power. The companies running these models pay for that compute, and the costs are substantial. OpenAI reportedly spends billions per year on compute. Now, how do you monetize this? Option 1. Charge users directly. OpenAI charges $20 per month for ChatGPT Plus. That's something, but most users use the free tier. And even at $20 per month, you need enormous scale to cover billions in costs. Option 2. Charge businesses for API access. Let developers and companies integrate your AI into their products. Charge per token or per API call. This is more promising. OpenAI makes meaningful revenue from API access. But there's competition. Anthropic offers Claude. Google offers Gemini. Meta open-sourced Llama. Amazon and Microsoft offer their own models. Prices are being driven down by competition. And if the technology becomes commoditized, if many models are similarly capable, margins compress. Option 3. Advertising. Make the AI free and monetize through ads. This is what Google does with search. It could work for AI, but it's unproven. No one has figured out how to elegantly integrate ads into AI conversations yet. And even if they do, the computing costs for AI are much higher than for traditional search. The unit economics might not work. Option 4. Productivity gains. The AI makes workers more productive. Companies pay for the AI because it saves them money on labor or allows them to do more with the same headcount. Microsoft is betting on this with Copilot. They're charging $30 per user per month for AI integrated into Office. If it genuinely makes workers more productive, companies will pay. But there's a chicken and egg problem. Workers need to actually use it consistently. The productivity gains need to be measurable and significant, and it needs to work well enough that it doesn't create more work through errors or hallucinations. We're still early. The business model is unproven at scale. None of these paths to monetization are guaranteed. And yet AI companies are being valued as if they've already figured it out, as if they're printing money, as if massive profits are inevitable. They're not. This is a technology in search of a sustainable business model, just like the .com companies. And history shows that most technologies in search of business models fail to find them. Now, let me talk about the hype cycle, because understanding where we are in the cycle is important. Every transformative technology goes through a predictable pattern. Initial breakthrough, the technology is demonstrated. It works. It's impressive. People get excited about the potential. This was ChatGPT launching in November of 2022. Suddenly AI could write essays, answer questions, generate code. It was a breakthrough moment. Then comes hyperinflation. Investors pile in. Startups proliferate. Everyone claims to be an AI company. Valuations soar. Media coverage is relentlessly positive. Pundits declare that AI changes everything, that traditional rules don't apply, that we're in a new paradigm. This is where we are now. We're in the peak hype phase. Then comes the trough of disillusionment. Reality sets in. The technology doesn't live up to the hype. Business models don't work. Costs are higher than expected. Revenue is lower than expected. Companies fail. Investors lose money. Valuations crash. This is coming. We haven't hit it yet, but we will. Then, eventually, comes the plateau of productivity. The technology finds its real use cases. The surviving companies figure out sustainable business models. The technology becomes genuinely useful and profitable, but only after the hype has died. After the bubble has burst. After most companies have failed and most investors have lost money. This is the pattern. It happened with the internet. It happened with clean tech in the 2000s. It happened with blockchain and crypto. It's happening with AI. We're in the hype phase. The crash is coming. Then, years later, the real value will be realized by the companies that survive. Let me give you some specific examples of AI hype that's gone too far. Companies adding AI to their name or their product descriptions and seeing their stock prices double. This is exactly what happened in the dot-com bubble. Companies added .com to their name and their stock went up. It's happening again. Small companies announcing AI initiatives they don't have the capability to execute, claiming their existing products are AI-enabled when they're using basic algorithms they've had for years. Investors aren't looking closely. They just hear AI and they buy. This is fraud, or at least it's deceptive, but it's working because the market is irrational. I'm also seeing AI washing in venture capital. Every startup pitch deck has AI in it now, whether or not AI is core to the business, because investors want AI exposure. If you're raising money and you don't mention AI, you won't get funded. So every founder finds a way to work AI into their pitch. This floods the market with AI companies, most of which aren't really AI companies. They're traditional software companies with an AI slide in their deck. When the bubble bursts, all of these frauds and near frauds get exposed. The real AI companies get dragged down with the fake ones. Investors lose the ability to discriminate. Everything AI-related crashes. Now, let me address the bull case. Because I want to be fair. I want to engage with the strongest arguments for why this time might be different. The bulls say AI is genuinely transformative, that it will boost productivity across the economy, that it will create trillions in value. And I actually agree with part of this. AI is real. The technology works. Large language models can do things that weren't possible a few years ago. AI will be integrated into many products and services. It will make some things more efficient. It will create some new capabilities, but here's where I disagree. The bulls assume that because AI is transformative, the current valuations are justified, that you should pay any price for exposure to transformative technology. This is wrong. Even transformative technologies can be overvalued. The internet was transformative. It did change everything. It did create trillions in value. But that doesn't mean internet stocks in 1999 were reasonably priced. They weren't. They were insanely overvalued. Most internet companies failed. Most investors lost money. Only after the crash, after valuations reset to reasonable levels, did the real value creation happen. AI will be the same. Yes, it's transformative. Yes, it will create value. But that doesn't mean you should pay $86 billion for OpenAI, or $2 trillion for NVIDIA, or that every AI startup deserves $1 billion valuation. The technology can be real and important, while the valuations are still absurd. The bulls also say this time is different because the big tech companies are profitable. They're not money-losing startups. They generate massive cash flows. They can afford to invest in AI. This is true. Microsoft, Google, Meta, Amazon, Apple. These are incredibly profitable companies with fortress balance sheets. They're not pets.com or Webvin. They're not going bankrupt. But that doesn't mean their stock prices are reasonable. A company can be profitable and successful while its stock is overvalued. Cisco was profitable in 2000. It was a great company with real products and real customers. But the stock was still overvalued by orders of magnitude. When reality set in, when growth slowed, the stock crashed. The company survived and eventually thrived, but shareholders who bought at the peak lost everything. The same can happen with today's big tech companies. They'll survive. They're too big, too profitable, too entrenched to fail. But their stock prices can still fall 50 or 70% if AI doesn't deliver the growth that's priced in. If you buy Microsoft at $3 trillion expecting AI to drive growth, and AI growth disappoints, you lose money. Even if Microsoft remains a great company. Now let me talk about the technical limitations of AI that people are ignoring. Because the technology isn't magic. It has real constraints. Large language models are probabilistic. They generate the most likely next token based on patterns in their training data they don't understand. They don't reason in the way humans do. They pattern match. This means they make mistakes. They hallucinate. They confidently state things that are wrong. For many use cases, this is a critical flaw. You can't rely on AI for anything where accuracy is essential unless you verify everything, which defeats the purpose. Medicine, law, finance, any domain where errors have serious consequences. AI makes too many mistakes to be fully trusted. Humans need to check the output. This limits the productivity gains. If I need to verify everything the AI produces, I'm not saving that much time. AI is also limited by its training data. It knows what was in the training corpus. It doesn't have access to proprietary information, internal company data, real-time information, specialized domain knowledge that isn't publicly available. This limits its usefulness for many business applications. You can fine-tune models on proprietary data. You can use retrieval-augmented generation. But these approaches have their own limitations and costs. Then there's the context window problem. Current models can handle maybe 100,000 or 200,000 tokens of context. That sounds like a lot, but for complex tasks, for analyzing large documents or code bases, it's limiting. You can't fit everything you need into the context window. And expanding context windows is technically challenging and expensive. The computational costs scale poorly. There's also the reasoning limitation. Current large language models struggle with multi-step reasoning, with planning, with problems that require working memory and explicit logical steps. They're getting better. Models like GPT-4 and Claude 3 can do some reasoning, but they're far from human level on complex reasoning tasks. They make logical errors. They get confused. They lose track of the problem. For many valuable applications, truly reliable reasoning would be necessary, and we're not there yet. Maybe we'll get there with future architectures. Maybe scaling alone will be sufficient. Maybe we need fundamentally different approaches. But the current generation of models has real limitations. And people are valuing AI companies as if those limitations don't exist, as if we've already achieved artificial general intelligence. We haven't. We're not close. What we have is impressive narrow AI that's very good at some things and still struggles with others. Let me tell you what I think happens next. I think we're in the second or third inning of the AI hype cycle. The bubble will continue to inflate for a while. Maybe another year. Maybe 2. Nvidia might go to 3 trillion or 4 trillion. OpenAI might raise at 100 billion or more. More AI startups will get funded at absurd valuations. More companies will add AI to their products and see their stocks rally. The media will continue to hype AI as the most important technology in human history. Pundits will say that anyone not investing in AI is missing the opportunity of a lifetime, and then something will change. Maybe it's a high-profile AI failure. A company that was supposed to be making billions from AI announces disappointing results. Maybe it's a technical limitation that becomes obvious. The models stop improving despite more compute and data. Maybe it's regulation. Governments impose restrictions on AI that limit commercial applications. Maybe it's competition. Too many companies offering similar AI products. Prices crash. Margins disappear. Or maybe it's just time. The hype cycle runs its course. Investors start asking about profitability, about return on investment, about when all this AI spending will translate into earnings. And the companies don't have good answers. When this happens, when the narrative cracks, the selling starts. It starts with the most obviously overvalued names. The AI startups with no revenue. Their valuations get cut in half, then cut in half again. Then the companies shut down. Then it spreads to the public companies. Nvidia has a bad quarter. Revenue growth slows. Maybe customers are pulling back on AI infrastructure spending. The stock falls 20%, then 30%, then 50%. Investors who bought at the peak panic. They sell. This creates more selling pressure. The stock falls further. The same happens with other AI-exposed stocks. Microsoft, Google, Meta, Amazon, they all fall. Not because their core businesses are failing, but because the AI premium in their valuations evaporates. They were trading at 30 or 40 times earnings because of AI growth expectations. Now they're trading at 15 or 20 times earnings because AI didn't deliver. That's a 50% haircut in stock price. And the small AI companies, the ones that don't have profitable core businesses to fall back on, they go to zero. The venture-funded startups run out of money and shut down. The public AI pure plays go bankrupt. The wealth destruction is enormous. Trillions of dollars in market cap evaporates. Not because the technology isn't real, not because AI isn't useful, but because the valuations were absurd. Because investors paid prices that assume perfection, and reality is never perfect. This is the dot-com crash redux, except with bigger numbers. The Nasdaq fell 80% from March 2000 to October 2002. I think the AI bubble crash will be similar. Maybe not 80% for the Nasdaq overall, because there are more non-AI businesses now. But for AI-heavy stocks, 70–80% declines are very possible. Nvidia could fall from 2 trillion to 400 or 500 billion. It would still be a valuable company. It would still be profitable. But the stock would lose 75% of its value. OpenAI's valuation could go from 86 billion to 10 or 15 billion if they can't figure out profitability. AI startups valued at billions would be worth millions or zero. This is not a prediction of when. I don't know if this happens in 2026 or 2027 or 2028. Bubbles can inflate longer than anyone expects. Irrational markets can stay irrational for years. But it will happen. The fundamentals always matter eventually. Math always wins. And the current AI valuations don't make mathematical sense. Now let me tell you how to position yourself. Because if you understand what's coming, you can protect yourself and potentially profit. First, if you own AI stocks at inflated valuations, reduce your exposure. I'm not saying sell everything. If you own Microsoft or Google and they're a reasonable portion of a diversified portfolio, you don't need to panic. These companies will survive. They have other businesses. But if you're concentrated in AI plays, if you own mostly Nvidia and AI startups and AI-exposed tech stocks, you need to diversify. Reduce your position sizes. Take some profits. Lock in gains while you can. Because when the crash comes, you won't be able to get out at today's prices. Second, avoid AI startups entirely unless you're a sophisticated investor who can afford to lose everything. The failure rate is going to be over 90%. Most AI startups will go to zero. Even the ones that sound promising. Even the ones with impressive technology, because technology isn't enough. You need a business model. You need sustainable unit economics. You need to achieve profitability before you run out of funding. Most won't. If you're a venture capitalist whose job is to take these risks, fine. Bet on AI startups. Diversify across many. Hope one or two succeed and return the fund. But if you're a normal investor with retirement savings, don't touch AI startups. The risk-reward is terrible. Third, be very skeptical of any company that's suddenly pivoting to AI. That's adding AI to their product descriptions. That's claiming AI is transforming their business. This is usually hype, usually an attempt to boost the stock price by associating with the AI narrative. The real AI leaders are obvious. The companies that were working on AI before it was cool. The companies with genuine technical capabilities and research teams. Everyone else is jumping on the bandwagon. Avoid them. Fourth, if you're sophisticated and understand options, consider buying put options on the most overvalued AI stocks. This is a way to profit from the crash. But be careful. Timing is everything with options. You can be right about the direction but wrong about the timing and lose money. Bubbles can inflate longer than your options contracts last. Only do this if you really understand options and can afford to lose the premium you pay. Fifth, hold cash, more than you normally would. When the AI bubble bursts, when tech stocks crash, there will be incredible buying opportunities. Great companies will be on sale. But only if you have cash to deploy. If you're fully invested in overvalued AI stocks, you can't take advantage. You're stuck watching from the sidelines, or worse, you're selling at the bottom to raise cash. I'm holding a significant amount in cash and treasury bills right now. Probably 30 to 40% of my liquid portfolio. Yes, I'm underperforming while tech stocks rally. But I'm protecting capital and positioning to buy when the crash comes. Sixth, focus on quality and valuation. If you're buying stocks, buy companies with real earnings, with reasonable valuations, with sustainable competitive advantages. Don't buy stories. Don't buy narratives. Don't buy promises of future growth. Buy businesses that are profitable today at prices that make sense relative to their cash flows. This is boring. It's not exciting. But it's how you preserve and build wealth over time. Seventh, study history. Read about the dot-com bubble. Read about the crash. Understand what happened to the companies. Understand what happened to investors. Learn from other people's mistakes. The patterns repeat. The details change, but the dynamics are the same. Greed, fear of missing out, suspension of disbelief, irrational valuations, and then the crash, the wealth destruction, the lessons learned. If you study history, you won't be surprised by what's coming. Let me tell you about some specific warning signs to watch for. These will tell you when the AI bubble is starting to crack, when the crash is imminent. First, watch for disappointing earnings from AI companies. When Nvidia or Microsoft or Google reports AI revenue that's below expectations, when the growth rate slows, when they can't justify the massive AI infrastructure spending with commensurate revenue growth, this will shake confidence. Second, watch for high-profile AI product failures. When an AI product is released with great fanfare and it doesn't work well. When it makes embarrassing mistakes. When adoption is low. When companies roll back AI features because customers don't want them. This undermines the narrative. Third, watch for changes in capital expenditure guidance. The big tech companies are spending tens of billions on AI infrastructure. Data centers, chips, training, compute. If they start cutting those budgets, if they announce they're pulling back on AI spending, that's a sign they're not seeing the returns they expected. Fourth, watch for insider selling. When executives at AI companies are selling large amounts of stock, they're telling you something. They're cashing out at peak valuations. They don't believe the current prices are sustainable. Fifth, watch for the first wave of AI startup failures. When the companies that raised at billion-dollar valuations start running out of money. When they can't raise follow-on funding. When they shut down or get acquired for pennies on the dollar. This is the crack in the dam. Sixth, watch for regulatory actions. If governments impose restrictions on AI, if they require licensing or limit certain applications, this will reduce the addressable market. It will make monetization harder. It will hurt valuations. Seventh, watch for sentiment shifts in the media. When the coverage turns from relentlessly positive to questioning, when articles start asking whether AI is overhyped, when skepticism creeps in, the media follows momentum. When sentiment shifts, the bubble is near the top. Now, let me address something important. Some people will say I'm too negative on AI, that I don't understand the technology, that I'm being a Luddite. Let me be clear. I'm not anti-AI. I'm not saying the technology isn't real or important. I think AI is a genuine breakthrough. I think it will have significant applications. I think it will create value. But I also think the current valuations are absurd. That we're in a bubble. That most investors are going to lose money. These two things can both be true. The technology can be revolutionary while the stocks are overvalued. This happened with the internet. The internet was revolutionary. It did change everything. But internet stocks in 1999 were still massively overvalued. Investors who bought at the peak lost everything even though the internet became incredibly important. The same will happen with AI. The technology will matter. It will be integrated everywhere. But that doesn't mean you should pay any price for exposure. That doesn't mean every AI company deserves $1 billion valuation. Valuation always matters. Price always matters. And right now, AI prices are in bubble territory. Let me also address the argument that you can't time bubbles. That trying to get out early means you miss gains. This is partially true. Bubbles can inflate for years. If you sell too early, you watch others make money while you sit in cash. You feel stupid. You second guess yourself. But here's the thing. I'd rather miss the last year of bubble gains than suffer through the crash. I'd rather sell at 80% of the peak and watch it go to 100% without me than hold through the crash back to 20% of peak. The math is simple. If you buy at 100 and it crashes to 20, you need a 400% gain just to break even. If you sell at 80 and it crashes, you avoided a 75% loss. You can buy back at 30 after the crash and still come out way ahead. Missing the top doesn't matter if you avoid the crash, and you can always buy back after the reset. After valuations return to reasonable levels, after the weak companies have failed and the strong ones are available at fair prices. Let me tell you what the post-crash AI landscape will look like, because it's not all doom and gloom. After the bubble bursts, after the crash, after the wealth destruction, the real AI industry will emerge. The companies with sustainable business models will survive. They'll be able to hire talent cheaply because all the startups have failed. They'll be able to acquire technology and companies for reasonable prices. They'll build real businesses serving real customers. The hype will be gone. The narrative will be gone. But the technology will remain. And it will be genuinely useful and genuinely profitable, just at much lower valuations. This is what happened after the dot-com crash. Amazon survived. Google went public after the crash. eBay survived. These companies built dominant positions after the bubble burst. They created enormous value for shareholders who bought at post-crash prices. But the investors who bought Pets.com and Webvan and eToys lost everything. The same will happen with AI. A few companies will dominate. They'll build valuable businesses. They'll create wealth for shareholders who buy at reasonable prices after the crash. But the investors who bought OpenAI at $86 billion or AI startups at billion-dollar valuations will lose everything. This is the nature of bubbles and crashes. They destroy wealth. They punish hype chasers and late adopters. They reward patience and discipline. They separate investors who understand fundamentals from gamblers who chase momentum. Right now, the AI market is full of gamblers. People buying stocks because they're going up. People investing in companies they don't understand because AI is hot. People assuming the party will last forever. These people are going to lose money, a lot of money. And the investors who are patient, who hold cash, who wait for reasonable valuations, who focus on sustainable businesses, they're going to make money. Not now, not during the bubble, but after the crash. When they can buy great companies at great prices. Let me tell you one more story from the dot-com era, because it illustrates the lesson perfectly. In 1999, Amazon was trading at over $100 per share. Everyone said it was overvalued. Everyone said it was a bubble stock. And they were right. When the crash came, Amazon fell to $6 per share, 94% decline. People who bought at 100 lost almost everything. But Amazon survived. It was a real company with a real business model. It kept growing. It kept improving its operations. And by 2005, it was back above $100. By 2010, it was at $200. Today, adjusted for splits, it's worth over $3,000. The people who bought at the peak in 1999 and held through the crash eventually made money. But it took over 5 years just to break even. And the psychological pain of watching a 94% decline was enormous. Most people couldn't handle it. They sold at the bottom and locked in catastrophic losses. The people who made real money on Amazon were the ones who bought after the crash, who bought at $6 or $10 or $20, who understood the business had real potential but waited for a reasonable price. They made 30, 50, 100 times their money. That's the lesson. Great companies can be bad investments if you pay too much. Wait for the crash. Wait for the reset. Then buy quality at reasonable prices. That's how you build wealth. I'm applying that lesson to AI. I think AI is real and important. I think some AI companies will build valuable businesses. But I'm not buying at today's prices. I'm waiting. I'm watching. I'm holding cash. And when the crash comes, when AI stocks are down 70 or 80%, when everyone is saying AI was overhyped and will never work, when fear replaces greed, that's when I'll buy. I'll buy Nvidia at $400 billion instead of $2 trillion. I'll buy the AI pure plays that survived at reasonable valuations. I'll buy the infrastructure companies that provide picks and shovels to the AI industry. and I'll make money. Not from riding the bubble, but from buying after the crash. Now let me give you a timeline. Again, I can't predict exactly when this happens. Bubbles have their own momentum. They can last longer than anyone expects. But here's what I think. We're in late 2025 now. The bubble could continue through 2026, maybe into 2027. Nvidia could go higher. AI startups could raise more money at even higher valuations. The hype could intensify. But eventually, something breaks. Some catalyst triggers the selling, and once it starts, it accelerates. Fear spreads. Everyone tries to get out at the same time. Liquidity evaporates. Prices collapse. The crash could happen over months, or it could happen over weeks. Depends on the catalyst. Depends on market conditions. Depends on 100 factors nobody can predict. But it will happen. And when it does, it will be brutal. My guess is we see the top sometime in the next 12 to 24 months. Then the crash begins. Then 18 to 36 months of declining prices and wealth destruction. Then, by late 2028 or 2029, we reach the bottom. Valuations are reasonable. The weak companies have failed. The strong companies are available at fair prices. That's when I buy aggressively. So here's my advice. Understand that we're in a bubble. Don't get caught up in the hype. Don't chase AI stocks at absurd valuations. Don't invest in AI startups unless you can afford to lose everything. Take profits if you've made money on AI stocks. Diversify out of concentrated AI positions. Hold cash. Be patient. Wait for the crash. And when everyone is panicking, when AI stocks are down 70 or 80%, when people are saying AI was overhyped and worthless, that's when you buy. Buy quality companies at reasonable prices. Hold for the long term. Let the technology mature. Let the business models develop. Let the real value creation happen. That's how you make money in transformational technology, not by buying the bubble, but by buying after the crash. I've been studying bubbles and crashes my entire career. I've lived through multiple cycles. I've made money by seeing bubbles when others couldn't. By betting against the consensus when the consensus was wrong. And right now, the consensus is that AI is different. That traditional valuation metrics don't apply. That you should pay any price for exposure to the most important technology of our lifetime. The consensus is wrong. AI is not different. It's the same story as every bubble. Transformative technology. Irrational valuations. Suspension of disbelief. And then the crash. The wealth destruction. The painful lesson that fundamentals always matter. I'm positioned for the crash. I'm holding cash. I'm avoiding the hype. I'm waiting for opportunity. You should do the same, because when this bubble bursts, and it will burst, it's going to be spectacular. And you don't want to be holding overvalued AI stocks when it happens. You want to be positioned to buy at the bottom, to profit from other people's mistakes, to build wealth while others are losing it. That's what I did in 2008 with the mortgage crisis. That's what I'm going to do when the AI bubble bursts. And if you're smart, you'll do the same.